Okay, good morning, everyone. My name is Bob Callanan. I'm with Business Ready Solutions, and I want to thank you all for coming to today's call to talk about our 5 tips for a better month-end close. Again, for today's webcast, we've got over 20 callers on the line, so I have gone ahead and muted the audio. But if you do have questions, feel free to type it into the chat window, and I'll answer them as best I can during the call or with an email or phone call afterwards. Also, if anyone in your company had planned to attend but couldn't make it today, we are going to record the webinar and we'll have it available from our website for you to take a look at, hopefully by the end of this week. If you want to look at last month's session, which was What's New in GP 2013, that one is already posted out on our site, so you can go ahead and watch that if you'd like as well. Just a quick overview of who we are. So Business Ready Solutions, if you're not familiar with us, we operate a little bit uniquely compared to other Dynamics partners and accounting software consultants. We operate primarily as an extension of your finance and accounting team. Our goal is to help you focus on your core business. We provide everything from accounting system selection, implementation, custom integrations, to month-end close, account reconciliations, and data entry. Our goal is to keep your financial systems running efficiently, accurately, and allow you guys to make your business decisions and remain business ready. So for today's topic, I know it's near and dear to how we help our clients each and every day, so I'm excited to have so many of you join us today. A couple of quick quotes that I like to hear, not like to hear, but do hear often from clients. This one I get quite a bit. If Dynamics GP or whatever ERP system they happen to be using is an integrated solution, why do I have to reconcile my accounts every month? Typically when I hear that, I need to pause and know that the company I'm talking to is probably going to have some growing pains as they get into their ERP system. It's always a big challenge moving from a system like QuickBooks or any other entry-level system up into your first ERP system, and Dynamics GP is probably one of the more popular ones that we see folks going to from QuickBooks. It does introduce some more reconciliation activities at month end that you simply have to do, but hopefully with some of the tips we learned today and your experience with other ERP systems, you'll realize that once you get things operating the way they're supposed to, the month-end process can be streamlined efficiently and significantly. Another one, same idea, we made a significant investment in the system. Why can't I get accurate financials? Well, if you're not doing the reconciliations or you don't have a good month-end close, you're not going to get good data out of your system. So again, hopefully today we're going to address some of those things. So what's the problem? When I saw some of the folks registering for today's session, I talked to a few, tried to get a sense for what their issues were around month-end close and what they hope to gain from today's session. A few of those comments are listed here. One of them, they're supposed to have their close done by the 5th business day of every month, yet they continue to close by the 10th. And they can't find a way to close that gap any further than they have already. Another one, during their last year end, they hadn't really been doing month end very well during the year because they were too busy just processing transactions. But when they got to the end of the year and presented their data to their tax accountant and started to do some account reconciliations that they probably should have been doing during the month, they detected a number of significant problems with their financial data. And it became, I'd say, embarrassing or a little bit of a sore point for the owner because some of his reports he had taken to the bank, and so he had to kind of come back with revised reports well after the fact. Some other common ones, just month end. We spend our month end consists of just compiling data. And we never really get to analyze the numbers because the data is finally produced so well after month end that by the time we finish it, we're ready to take a deep breath and start with the next month end close. So we never really get any benefit from that month end close process. So again, hopefully we're going to hit some of those today. So quick recap. Why do we even close the month? One of them is risk management. All right, we need to make sure that our assets are properly protected and accounted for. So we run an AR aging and tie it to the ledger so that we know that what we have in accounts receivable is real and collectible. We do our bank rec to make sure that we know where our cash is. So we look at that for, again, from a risk management standpoint to make sure we know what we have and where it is. The bigger one, decision making. We need to provide management with financial data so they can make decisions. And the third piece is just regulatory. So some of our clients need or are required to do a close at least quarterly for SEC reporting purposes. When I look at month-end close, I like to break it down into phases. It helps, I think, if you can break it down this way to understand where you are in the process and what tasks need to be done next, and not try to jump ahead to the end solution before you do everything else. So when I look at a month-end close process, the first thing I talk about is pre-close. Okay, all the activities that happen pre-close might be journal entries, getting data from subsidiary systems into your financial system if you have this data outside of your system, making sure that things are posted properly into the system. So pre-close activities. The next step is just compiling. This might be doing accruals for estimates and getting through all of those account reconciliations. So we'll hit account reconciliations a lot today, but that compilation phase is where you're just starting to tick and tie and get everything right and get everything into the system properly. Once that's complete, what we do is we want to run our first set of draft financials, and that's where we start our analysis and review. And this is a step that often gets overlooked, especially if the pre-close and the compile phase are so overwhelming that we don't get to spend time in that analysis and review phase. So during that phase, we're looking at variances. Hopefully we've got our budget in the system. We're comparing actuals to budgets. We're comparing actuals to prior periods or prior years, and documenting what those differences actually mean. This is also the phase where the CFO or whoever's reviewing the financials would do some sort of sign-off on that. And then the final phase is your reporting phase. This is where you actually generate the report, the final set of reports that would go to your board, to your president, to your stakeholders, whoever needs to get those reports. That last step, again, getting those summary reports out the door. So again, for some of our clients, we see those steps being skipped. Maybe the compile phase is kind of shortcutted a little bit, and we jump straight into reporting, or in some cases we go straight to reporting. Okay, so tip number one, let's talk about setting expectations. I think for a lot of our clients, we need to define what kind of close we're actually doing. So for some of you, if you've got SEC requirements or an external board that really wants a hard close done, we need to understand that, and everybody needs to be on the same page that this is what we're performing. So we could be doing a hard close, we could be doing a soft close, or what I'll call a virtual close. All of them are acceptable on a monthly basis. I think if you're doing a virtual close monthly, at some point you might need to do a soft close or even a hard close at the end of the year. But they're all acceptable tools for closing. The key is making sure that everybody, internally in your finance team to externally your stakeholders, understand which type of close you're doing. So again, a hard close, every account is reconciled. All of your accruals are set according to GAAP properly. A soft close, maybe some of your accounts you're just doing variance analysis on, or using estimates to do accruals. With a soft close, obviously you're going to be able to close sooner than you would with a hard close, but there's still some work to be done on the compile phase as well as the review and analysis phase. With a virtual close, you've kind of reached a point where your reconciliations are happening all during the month, and your close is really just those last two phases, analysis and review and reporting. That's probably a place that everyone would like to get to, but again, for one reason or other, you may have certain accounts that just have to be spot on, and you have to do some sort of reconciliation process to get there. Again, one of the things we see getting our clients tripped up when we talk about these three different types of close is that when a new CFO comes on board or a new controller comes on board, if in the past a hard close was done every month and that controller or CFO wants to move toward a soft close, if it's not communicated to everybody that we're kind of changing the expectations of what our reports are every month, you may have stakeholders, you may have a president who's getting reports and using them a certain way and making certain assumptions or decisions on them that he may not want to make if it's not truly a full close. So again, staying on the same page with your expectations here is going to be critical to how the report gets used and what you can actually do and how quickly you can actually close. Tip number 2, just getting schedules and documenting the close process. So not everyone has a true financial close calendar. We definitely see that at larger companies where you know that on month end +1, these tasks need to be done. On month end +2, these tasks. Month end +5, we generate our draft financials, and month end +7, we generate our final financials. And everything needs to happen and has to happen in a certain order, and everyone's on the same page. Again, common with larger companies. I don't think it's unreasonable for smaller companies to have something there as well. I'm going to share out just a quick and simple spreadsheet so you can get an idea of what I'm talking about there. So let me bring that up for you real quick. So again, it could be something as simple as this, where you just have a close checklist where these are the things I do pre-close, who's the owner of the activity, who signs off on it, what is its current status, and any notes about what's happened with that task so far. If you put a spreadsheet like this together, have it submitted to the controller or CFO on a daily or every other day basis as you work through the close, you've got some good documentation, good information about what's causing bottlenecks in the close process, how you can speed it up, because you've got some notes there from month to month explaining what's actually happening. If anybody wants a copy of that, just go ahead and drop me an email and I can get that out to you as well. Okay. Same goes with instructions and procedures. So getting the actual instructions on how to either work through an account reconciliation, for example. Accounts receivable, we have some clients that will call up on occasion and say, all right, my accounts receivable, what report do I run every month to tie to my AR on my balance sheet? That's data that ought to be documented internally with your systems documentation or accounting procedures documentation, exactly what report, what exact parameters I run to produce a report that will tie to my balance sheet for accounts receivable, accounts payable, any of my other balance sheet accounts. So getting it written down, I think, is critical, and too many of our clients don't have that documentation written down today. And I mentioned earlier, ownership of tasks, just knowing who's responsible for what, when it's due, who reviews it, and keeping up with the status of what's done and what's not done. And then just a simple wrap-up meeting at the end, just to review what worked and what didn't work. Again, good example, somebody has a question or a problem during month-end close. They struggle to reconcile a certain account. They finally get it resolved, and the very next month, either a different person is reconciling, and they run into the exact same issues or challenges that the other person had, or the person that's doing it in month 2 forgot what was done in month 1 and has to go through that same learning curve again of finding out what reports are run, what transactions are not posting properly in the system. So having it documented in that report will allow them to go back in the second or third week when they're a little bit quieter and try to work through those issues so that the following month the reconciliation process happens quickly and easily. Okay, tip 3, I'll get into some demo stuff here in GP to give you some ideas of what I'm talking about here, but automating your reconciliations. Account reconciliations can definitely chew up a lot of time during month end. So to the extent we can automate them, we can definitely save some time. So I'm going to show you a few examples inside of GP on what we can do. One is bank reconciliations, and the other one are just a handful of other balance sheet accounts where inside of GP we can actually run some reports, look at some data to see how we can potentially reconcile this account better. Let me jump over to our demo environment here. Hold on. So looking inside of, this is GP 2013, one of the tools that comes out of the box with Dynamics GP that we don't have too many clients using is the electronic reconcile. For your bank recs, in a number of cases the bank rec gets mailed to our clients still. Hopefully they're able to download the data electronically, at least go out and print a PDF copy of their bank rec the day after month end. But for some, we're still waiting to the 3rd or the 4th or the 5th of the month before we get our bank statements. With electronic reconcile, what we're able to do is if your bank can provide you a file with your bank activity, you can grab that data once a week or every day if you've got enough activity, and using the configurator and download maintenance, we can set up an integration to bring in the bank activity every week into the bank rec module. Once this data is downloaded and brought into GP, when you open up the bank rec window, it will take the data that you've downloaded and it will attempt to match it for you. So it will compare check numbers and amounts and dates, and I believe even the vendor number or vendor name, and try to tell you, okay, this one's cleared, this one's cleared. Here are some transactions on your bank statement or in your download file that don't exist in GP so that you can quickly add them. And here's what's left to be reconciled. So every day you can keep your bank statement or your bank accounts near reconciled all through the month so that when you do get to month end, you don't have a 2 or 3 or 4 day lag trying to get your bank recs caught up. So again, electronic reconcile, it's part of the base system. Definitely worth looking at and getting configured. The other tool we have out there is a routine called Reconcile to GL. And I know a lot of you are using this today. With GP 2013, we've added some more to it as well. So in earlier releases, we were able to use this Reconcile tool to help reconcile accounts receivable and accounts payable. Today, we can also do inventory as well as bank rec. So all 4 of those balance sheet accounts now, you can use this tool to quickly see where the accounts may have been off. Generally, what's happening here is you've run, let's say, an AP aging report, and it doesn't match to your balance sheet, and you're trying to figure out why. What we can do with this tool is we can simply choose bank accounts payable, list our AP bank account up here, or our GL account. So account 2100 is trade accounts payable. And when we process, it will create an Excel spreadsheet and tell you what transactions are out there and what their status is. So in this example, it didn't find any transactions that were unmatched, but it did find some transactions that potentially had some problems. And then it also listed all the transactions that did match. what I'm seeing here is on my left-hand side, everything from my accounts payable subsidiary. On my right side, all of my general ledger transactions. It matches based upon the transaction source, the voucher number, and the amount. So in this first line right here, this is potentially matched because the source and the voucher number match up, but the amount did not. So something changed with that transaction somewhere along that posting process. The others, the amounts matched up, but for one reason or another, the document number did not. So account 2061 in my accounts payable became receipt number 1139 in my general ledger. So that one probably is fine, but we might want to explore why that's happening so that next month those two columns do match up exact and they end up in my matched column. So down below, these are all the transactions that did match up properly. Source, voucher number, and the amount all match up, so they're fine. So again, what often happens is we run this report, we get a list of unmatched transactions, we're able to look at those straight into GP and say, oh yeah, someone made a journal entry, let's reverse that because it should have gone to, instead of accounts payable, maybe it should have gone to accrued expenses. And we can just reclassify it and then we're back in balance again. Or in other cases, we find issues on the subsidiary side where a transaction distribution, somebody overrode the payables account with a different account, and then we've got to go back and resolve that a different way. So a good tool to explore and just discover what potentially could be off. And the other tool that we encourage you to use is just simple smart lists. If you don't have smart lists today, or if you're not comfortable with it, you definitely want to start to use this tool more and more, or Smart List Builder, just to go after lists of transaction data. So I could jump into purchasing, for example, and payables transactions, and just get a list of transactions by a certain date range, and quickly take that data to Excel to do further analysis. So as far as reconciling goes, there's lots of tips and things out there to do that. Let me jump back to our PowerPoint. The other thing that you can explore doing is, for some of these accounts, look for ways to do mid-month or weekly bank recs. I mentioned the, for cash, trying to do bank recs every day or every week. The same can be true for inventory. If you've got inventory issues where every month end your inventory is out of balance and you just can't find it, try and do a bank rec every day or do a inventory rec every day or every week to see if you can discover what is actually coming off. It sounds like a lot of work, but once you discover what that issue is, and you correct the process, then moving forward, you've saved yourself a lot of time at every single month end. But again, moving that reconcile activity away from the month end close is going to save you a lot of time and allow you to get your close completed quicker. Another area that we run into here, back to reconciliations, is the choice of account numbers we have. So we have a lot of, when you look at your chart of accounts, I'm going to jump back to our demo again. When you look at your chart of accounts, you need to make sure that you know how to reconcile every account on your balance sheet, and even to do some good analysis of what's in many of your P&L accounts. Let me bring up an account list here for you, give you an example. So when I look at accounts receivable, I need to understand, or I need to know and make sure everyone knows that this particular AR account, the only activity that should go in and out of this account is activity coming from my receivables module. If I have users making journal entries to this account, or I have users that are, for whatever reason, entering payables transactions and actually hitting my AR account, I'm going to have problems at month end reconciling this account. One thing you can do is use this flag called allow account entry. So if I turn this flag off as it is right now, that will prevent anyone from making a GL entry to this account. It'll prevent anybody in accounts payable or any other module from using that account in a way that it really shouldn't be used. So sometimes we try to take shortcuts with posting to get things where they need to be, and ends up backfiring in a lot of cases. So in this scenario, if you unmark that for your AR account, your AP account, inventory, cash, that will definitely eliminate some problems you may have with your month-end account reconciliations. The other scenario here is to make sure that everybody understands what account how each account is supposed to be used. So again, this account is only posting from the receivables module. You may have another account, allowance for doubtful accounts, that should only be coming from my general ledger. So again, defining the account, defining how it's to be used will definitely save you time. Again, we've seen situations where clients have 3 or 4 different trade AR accounts or multiple inventory accounts. What you're doing when you introduce multiple balance sheet accounts is you're having to do multiple account reconciliations when you do that. So I try to keep my balance sheet as simple as possible with as few accounts as possible so that I don't have as many things to reconcile. But again, you may have to split them out to make account reconciliations easier. But you definitely want to do, there's a trade-off there. You want to have is what you need to reconcile, what you need to versus what you need to report against. The same goes true when you talk about, if you're in distribution, when you're looking at sales and COGS. Having lots of revenue accounts and COGS accounts are great. You can definitely do a lot of sales analysis with it, but you need to make sure that they match, so that what's going into sales for a certain location is what's also going into cost of sales for that same location. That way you are in fact getting accurate profitability by location. And then when you get into all the other accounts, sales returns and inventory adjustments, variance adjustments, knowing what each of those adjustments represents will help you with that variance analysis down the road. And again, in GP 2013, there is some new functionality that helps for distribution companies. I'll quickly bring it up here if I've got it set. I think I do. When we're doing inventory adjustments today, we now have a field that's called reason code. And what that does for you is it allows you to set up or post an inventory adjustment. And if you have on your P&L, variance adjustments due to physical inventory or adjustments because you're consuming inventory, in the past what had to happen is the person doing the inventory transaction had to go to the distribution window and enter the GL account. And what typically happened is it all got lumped into just one big inventory adjustment account for everything. And so month to month that adjustments account would swing pretty dramatically, and it was very hard to explain what actually happened. So now with the reason codes, we can create reason codes. Reason codes can map to different GL accounts. So when a user is entering an inventory adjustment, they can choose a user code or a reason code. Let me set one up here. And they can tell it that this is for internal use, this went to samples, or this was truly shrinkage. And based upon the code that they choose, okay, it will post to a certain expense account. So now we're getting more accurate data back in our P&L for analysis around sales and cost of sales and gross profit, because we're putting our adjustments in the right buckets. So again, for distribution companies, getting that configured will definitely help with your reconciliations and your variance reporting. All right, let's jump back to here. Okay. So again, automating your reconciliations. The fourth tip I want to go over is just defining what is month-end and what is monthly. In a number of cases, we get into month-end close and we introduce a number of tasks that they're not part of the close process. they're just something that we've learned to do, or over time have just decided to do every month. And we just decided, since we're doing it once a month, let's just do it at the beginning of the month or right near the end of the month. So in some cases, some of these, if you can move them away or define them as pre-close or post-close processes, you can potentially shrink down the month-end close process itself and get those financial reports out the door sooner. And those might be things, I've got some examples here, I'm sure there are more. Maybe how you do commissions. If you can do commissions other than on a monthly basis, maybe cutting off the sales period on the 25th of the month or going to the 10th of the month, you might be able to save some time. There's always the trade-off there that you potentially need to make accruals, but if your numbers are consistent and you can estimate fairly well, you might be able to do it. Generating customer statements. So again, we close our AR and get it reconciled, and that's generally the time when we think, okay, month end, let's do customer statements. Well, there's no reason why that can't be part of your post-close process. Get your statements out the door on the 10th of the month after you finish getting your final set of financials presented to your board. Then you get into customer statements and that collection process that may follow up. Even customer invoicing. Again, we like to invoice on the last day of the month or on the first day of the month. I'm definitely guilty of that. But if we can do that mid-month, again, potentially you may need to do accruals. If the accrual becomes more complicated than it's worth, then you may not need to do it. But again, it's something that could potentially be moved. Sales taxes is another one, possibly. Again, you're kind of stuck to month end on that one. But actually processing and calculating it could be pushed to a post-close process. And then payroll. Again, the accrual issue was definitely the trade-off there, but everybody likes to do payroll today. It's either mid-month or bi-monthly or end of month. If you can just do a mid-month only payroll and pay everybody on the 15th of the month, once a month, you can get your payroll entry entered well before month-end close. And if your employee staffing is fairly consistent from month to month, you don't even need to make that accrual because it's going to be about the same month over month. Again, if you have a big accrual, maybe that's not going to work for you, but definitely worth taking the time to look at what's in your month-end close process and either moving it out to call it post-close or moving it back to pre-close activities, again, to shorten that time frame when you're actually doing your close. Okay, and the last area is just automating that financial report package. I think in order to do that, we first need to really step back and decide what it is that's going to go into that report package. Who uses the financial data? What do they need? Get the reports designed and agreed upon with your stakeholders, with the president, whoever gets those reports, and make sure they're getting the same thing every month. Also, when you're looking at reports, I see this happen quite a bit. We've got some reports that we're calling part of our report package, but really these are reports that we're using for the reconcile process. So when you think back to the phases I mentioned earlier, the reconcile process and even the analysis process, there are some detailed reports that we run. A trial balance is a perfect example, or a detailed AR aging. Those are reports that don't really represent, to me, your report package. They're reports that you use to help reconcile and close your books. So deciding what is what there, I think, is helpful. And then the third step there is just avoid Excel to compile your reports. If you're using Dynamics GP and you're still creating your financial statements in Excel by taking the trial balance out to Excel and massaging the data and doing that, you're spending a significant amount of time on a process that can be automated and be done very quickly. So let me jump over back into GP and talk a little bit about Management Reporter. Close these down. So within Management Reporter, we can build a number of different report definitions. So as an example I've got right here, I'm listing, I think, 7 different reports that represent my month-end package. So MA balance sheet, comparative sales mix chart, a sales performance report by month, sales performance annual, consolidating P&L with my eliminations, a gross sales trend, and a net sales trend report. My list could be 20 reports long. For some companies, it may only be 3 or 4. But you want to agree on what those reports are. You want to build them inside of Management Reporter. And what the other thing that's nice about this tool, without getting too deep into how it functions, in the latest release now, we can actually create what are called report groups. So I can build a report group called my month-end package and simply tell it that these are the 7 reports that I want to include in my month-end package. I can tell it what order I want them to generate in. So if I want my sales trend report to go first, I can do that. With this report group, you'll notice I have my generate button up at the top. So with this report group, I can at any point in time come in and generate it, and I have all 7 reports being created and saved out to a reports library where I can view them. I could export them to Excel if I wanted to do that, or publish them out to SharePoint, or email links off to the president or anybody else that would have access to it so they could see their data. I can also go a step further with that with report scheduling. So if I do have a large report group with lots of reports in it, with reports going to different users, I can set up a schedule. If I learn that my report package takes 20 or 30 minutes to generate because I've got so many reports in it, by scheduling this, I can have it automatically go. And in this example, I've got my month-end package, that same report group I showed you earlier, set to run 5 days after month close, then again 10 days, and then 15 days. So if I've got my month-end close process down, the one after 5 days is my first draft that goes to the CFO. So every day on the 5th day after month end, this report gets generated. The CFO gets a link in an email that says your reports are ready, and he can open that up and see his reports on the 5th day every single month. Same thing happens on the 10th. So he gets draft number 2, and then on the 15th they get their final package. So again, quick and easy way. We don't need to wait during the day to run these reports and have them saved off someplace. They just happen on their own. Okay. Okay, at this point, I'm going to wrap up our call. I'll take any questions if you've got them. Maybe I just lost my slides here. Hold on. That's all I got for today. I hope that helped and gave you some ideas. A couple other quick things. We are going to have an announcement come out shortly on what our August topic is going to be. So definitely look for that. If you've got any comments about today's session, I want to talk more about what we discussed, I'd love to hear from you. If you've got ideas on other topics, definitely send those along to us. And with that, just thank you and hope you guys have a great day. Thanks.